Welcome to Playing with Unicorns, episode 3. So this week we're going to discuss how venture capitalists or VCs evaluate startups. So let's get rolling. So in episode 1, we discussed how to fundraise, when you should be reaching out investors, which types of investors, etc. And let's assume you've done all the steps required. You're now ready to go and pitch VCs. And the question is, how are they going to be evaluating you? And obviously different venture capitalists have different criteria, or at least weigh things differently. There are 4 fundamental ways that you're going to be evaluated against. And so every venture capitalist in the world is going to look at the quality of the team, is going to look at how interesting the business you're in is, what the deal terms are, and whether or not they're reasonable in light of the company you're building and where you're at, and whether or not it fits with their thesis, what they are investing in general, but also more specifically in that category, what is interesting to them. Let me add the chat so we can all have it. So, starting with the team. The thing is, every venture capitalist in the world tells you, I invest in extraordinary people. The thing is, that's extraordinarily subjective. And the issue with that underlying subjectivity is that it can leads to these cognitive biases. And so given that many venture capitalists are young white males who went Ivy League schools, they have a tendency to appreciate people that are similar to them. They have a tendency to invest in young white males who went to Ivy League schools. And so what we've been trying to think through is, if you take a step back and you look at the underlying conditions, what are the required skills that founders need to have to be objectively better and to lead to success? And I guess the way I would present it, there are 2 fundamental skills and then a set of other skills that go along with it. But the first one is storytelling skills. Someone who can weave and sell a compelling story is extraordinarily valuable. And it's extraordinarily valuable because if you can sell an amazing story, you're going to be able to raise money at a higher valuation. You're going to have an easier time attracting capital in general. You're going to be able to build a better team and attract more talent. You're going to be able to sign extraordinary business development deals to grow the company faster. And you're going to get a lot of free PR and press. And the thing is, and by the way, by storytelling skills, it's really the way you sell your story, right? Imagine that you're trying to build a company, or you're building a company and you're coming to pitch it to me. And I ask you, why are you building this? And if your story is, well, I've done a fundamental market analysis, I've researched the market is really large and attractive, the incumbents are slow moving, and my approach is better. I mean, that's okay. It's a good reason to be building a company, but that's not a story. The story is more, this is a problem I've faced my entire life, and I've hated the experience that I've faced, and it is grating to me to the point that I'm dedicating the rest of my life to solving this. And because I've experienced it so much, I know exactly what the solution is. And that passion and that connection to your underlying story and why there's that intersection between your story and the company you're building is more compelling. Now, obviously, it's not a very specific example, but it gives you a sense of what we're looking for. But if you only have storytelling skills, it's actually not enough, because if you have extraordinary storytelling skills, but you don't have analytical skills, maybe you build a very large business, but not a very profitable one. So maybe you build, fab.com. You get hundreds of millions of revenues, but you never have unit economics that work, and the company doesn't make money. Or maybe you're Theranos, and you sell this fundamental story that everyone wants to believe in, but it ultimately doesn't actually work. So the second thing you really need is, I need the founder and the founding team, and frankly, it should be the founder, especially the CEO, that needs to be both have the storytelling skills and be metrics driven and analytical. And the reason that's important is you need to understand the business you're in. You need to understand how you're going to be able to scale it, how you're going to be able to execute in it, and how you're going to be able to raise, and how you're going to be able to get positive unit economics in it. The issue is if you only have that, you may build a small business that's interesting, but you're not going to build a large, extraordinary business. So you do need the storytelling skills to get the scale, and to be numbers driven and analytical to be able to execute. Now, as you're selling the story, of course, you're going to demonstrate passion, so that's kind of part of storytelling skills. And we also look for grit and tenacity. The thing is, as we're evaluating you, it's a couple hours of conversation over the courses, depending on the venture capitalists, of a few weeks or a few months. The way we're gonna test for it, because of course we don't know if you can execute or not, especially if you're a first-time entrepreneur, is looking for it in your background, but it need not be there. It may very well be that you came from a well-off family and you worked really hard, but you got good grades at school, you went to great college, and then you had this great idea and you're executing. Okay, that's fine. And so it's more, as we challenge you, as we challenge your assumptions, as we challenge your where you're going to get, why you're doing this business, we test how you react to this. Because of course, if you crumble under the pressure of the questioning we put upon our analysis and our perspective on the business, then obviously you're going to crumble against the much bigger pressures of succeeding as an entrepreneur. But at the end of the day, we can't really test for it as much as try to take a guess at it by challenging you and your assumptions. And so ultimately, storytelling skills and probably metrics-driven and analytical, and having that intersection. Because the thing is, many people are amazing storytellers and many are great executors. But people that can be both, that Venn diagram intersection is really rare. And if you have it, or when you have it, that's when we want to invest. Because if you have either of those, it's not going to be enough. Okay, so now we have a founder that's amazing that we want to back. For some VCs, by the way, that may be enough, and I'll explain why later. But for many other VCs, they're also interested in what business are they in. Is the business compelling? And there are a number of things that lead to compelling business, actually. And you can think of, is it a large market? Can you create $1 billion company here? Are you in a position to be the market leader? Is this scalable? And there are a lot of ancillary things that go around all of these things. If you're going to be building a very valuable large business in a marketplace environment, it probably means you're not going to be disintermediated. It probably means there's reasonable fragmentation on the supply and the demand side. But to me, these all fall under the subset. Is there an opportunity to build a $1 billion company here? Which means the market needs to be large enough, maybe not today, but at least to be growing there. But there's one thing above all else that I care about as I'm evaluating the business is, does it have attractive unit economics? Now, if you're pre-launch, they can be theoretical unit economics. If they're post-launch, they can be actual. Now, the thing is, most entrepreneurs I talk to, or many, especially first-time founders, don't know what I mean by unit economics. And so I'm going to do a little segue in terms of what are unit economics, how do you evaluate them, why is it important to evaluate them, and what are pretty good at unit economics. And also, in the theoretical framework, if you're pre-launch, how do you evaluate whether or not you have good unit economics, or maybe have good unit economics in this case. So again, a little subway, what are unit economics? How do they work? So the reason unit economics just generally is, instead of looking at a business from a revenue perspective or overall profitability perspective across all the different sales you may have, which frankly, it's informative. It's somewhat informative because you need to know how much growth you have and how big the business is. But these businesses that we're investing in at the seed stage or the pre-seed stage or the A stage, they're all rather small. And by the way, they're all losing money. And the reason they lose money is they have an underlying fixed cost base, which is employees, offices, et cetera, but they don't have enough revenues to be able to cover those costs. And so there's absolutely no expectation that companies are going to be profitable at seed A, frankly, even B. But while the companies need not be, or not going to be profitable overall, it's important that whenever they sell something, they make money off of that. And that's where the unit economics come in. So if you're selling a widget, you need to get some margin out of that widget that's positive. I'm going to talk about how positive it needs to be. So let's go through what unit economics are. So you have a sale, and I apologize for the fact that I use acronyms here instead of using the full word, but I'll go through them. So when you're selling an item, it has an average order value. It is the price at which you're selling it. In the case of a marketplace, which is my bread and butter, it's what is the gross merchandise volume? What is the volume? How much are you being paid for the product that you're selling? Now I'm going to use a marketplace example here. So I'll first I'll do it theoretically, and then I'll go in and do it practically with an example of a product. I mean, it'll be a widget, but it'll still be an example. So then a marketplace takes a percentage of that. If it was in e-commerce, maybe it would have a margin on that, whatever. But in this case, we take a percentage, and that gives you your net revenues. And that net revenue number is really important because in a way, that's what your VCs are going to look at different stage to evaluate whether or not you're ready to be you're ready to be invested in, basically. But that's not enough, because in order to execute and to sell that whatever it is you're selling, you have a number of costs. Maybe you have costs in terms of making the transaction happen, plus you have billing costs, maybe you have shipping costs, but you have all these variable costs or cost of goods sold that you cover. And if you remove all of that, you have your contribution margin. And that contribution margin is what we're looking for to be very positive. And then if you want, you can also compare it to your customer acquisition costs, or CAC, and I apologize for having used acronyms, which gives you your profit margin on the first transaction. But the fact that people bought one item and that you're making money on it, it may or may not be interesting. But what's more interesting to us as investors, and frankly to you as an entrepreneur, is each individual customer, how much are they worth to you over time? What is the long-term value of that customer? And so what we really care about is the margin you're making times the number of transactions that they're going to do over the lifetime that they're a customer of yours. Now, again, if you just launched, you may not know what the answer is, but you can maybe find out what it is for the industry as a whole, or you can see that for the first 6 months, they're buying once a month, once every 2 months, and therefore you can make some predictions as to how many times they're going to buy. And the next thing that's really important is what is the long-term value relative to how much a customer is costing you to acquire. Because of course, most companies, they don't have this viral organic growth. They need to get customers some way. And you can get them through paid marketing on Google and Facebook. You can get them through a sales team. There are a number of channels, but these things cost money. And you need to compare what the value of each customer is relative to the customer acquisition costs. Now, give you a sense of what would be good long-term value relative to, actually, let's go through a practical example, and then I'll go through what I think would be good LTV to CAC and good long-term value metrics. So fictional marketplace sells an item for $1,000. That's what the consumer is paying and flows through the marketplace. The marketplace takes 10%. That's the rake or the take rate. And so the revenues to the marketplace are $100. And again, this could be, I've seen numbers like that in a number of marketplaces for higher end goods. Now, in order to fulfill that transaction, the marketplace is like, they have to pay the Stripe fees or the billing costs, the fees, and they probably have costs in terms of customer service, or maybe matching fees or delivery fees. And so net revenues, they have $20 in costs, is their contribution margin is $80. And so on the first transaction, they're making $80. And then they look at how much people are spending per year. And this is, let's say, a case where people are buying it 4 times a year. And on average, they keep the customers for 2 years, which gives an LTV of $640. And so then you have to compare this to how much it costs them to acquire the customer. In this theoretical marketplace, let's say, costs them $100. And therefore, they have an LTV to CAC ratio of 6.4x, which is rather good. So let's go actually and now think through what are good unit economics. So good unit economics from our perspective is one where you can recoup your customer acquisition costs within the first 6 months of operating. And over the first 18 months, ideally, you do about 3x in net contribution margin what your CAC is. And maybe you don't even know what the LTV to CAC is. Maybe it's 10 to 1 or 20 to 1, because even though you may lose some customers, the remaining ones may be buying more and more from you. That's something called negative churn. And ultimately, hopefully, perhaps your margin goes there. Now, let's imagine that you're pre-launch. So you're like, wait a minute, I'm pre-launch. I don't actually know what the unit economics are. The thing is, there are a lot of things you can do to test what they can be. So first of all, in terms of what the average order value in the industry is, that's actually usually rather known. What the underlying cost of goods sold and margin is going to be is rather known. So actually, the contribution margin side, you can get a good sense of. The part that may be harder is what is the customer acquisition cost going to look like? But there are ways to test it. So let's say you have an idea, you think it's really good, you're going to create a landing page. So you haven't built a site, so you don't actually go through what I said last week of building the MVP. You're not there yet. You build a landing page that presents something that kind of looks, it's static, that kind of looks like the site might look, but just tells users, sign in. And so then you see how much it's costing you to acquire to send customers there. So perhaps you're like, oh, I'm spending $1 per click on Google, and 10% of these are signing in. That's a $10 to a sign up. Now, of these people who've signed up and said they're interested, what percentage do we expect to buy? And then, frankly, you can actually usually look and find the average in the industry. Maybe 1% of them, the visitors to a website in the category buy. So you say, okay, 1% of these are going to buy. So that would be a $100 customer acquisition cost. But whether or not, so as you're launching your business, you're evaluating it, you want to see, okay, is there product market fit? Can I make the unit economics work? Can I get a customer acquisition cost that's low enough? But the next thing to test is there enough density or depth in your customer acquisition channel that you can scale the business? Can you spend $50K a month, $100K a month, $500K a month to make it work? Otherwise, it may not be a scalable business. So as you come in to see us as an entrepreneur, I really want you to have thought through what your unit economics are. Again, if it's pre-launch, theoretical unit economics. If it's post-launch, your actual unit economics. Now, they may not be there, meaning maybe your unit economics you don't have yet a high enough contribution margin. But as long as you can talk through why the unit economics you have are going to get there without needing all the stars to align, right? Again, what I'm looking for is recouping the customer acquisition costs in 6 months and 3xing on a contribution margin basis over the first 18 months. Now, perhaps you're in the food delivery business, and right now you're paying your food delivery drivers $15 an hour, but they're only doing 1 delivery per hour. And as a result, your economics are underwater. But if you tell me, look, right now I'm 100K a month in GMV or gross merchandise sales. If once I'm at 200K or 300K, people will be doing 3 deliveries an hour, and that cost per delivery is will come down to $5, and at that scale, the unit economics work. That's actually a believable and compelling story. Or maybe you're like, the shipping costs are high, but with scale, the FedEx, UPS costs go down for whatever product you're selling, or the leverage you have over suppliers goes up, and as a result, your margin goes up. As long as you have a compelling story for why you're going to get there, even if your economics are not there yet, that's okay. So now we have a team we love. We have a business that seems very attractive. What are the deal terms? Now, not every, and by deal terms, I mean, at what valuation are we able to invest in? How much is the company raising? And are there other terms in terms of that are being offered to investors? Is it preferred? Is it a convertible note versus an actual equity round? Which rights are being given to investors? But frankly, it's really valuation that I'm thinking about mainly here. And there's a clear sense typically of what is the correct valuation for the right traction, for the right opportunity, for the right team. And I've presented this in the past, but it's really worth revisiting. What are typical, and I'll go through what's typical in general, and then what's typical in the marketplaces we see, perhaps in the other order, actually. So in marketplaces, for those who are interested in marketplaces, there's a reasonable set of expectations. Now, I'm going to take a marketplace that takes a 10 to 20% take rate, and if your marketplace takes 2% or 3%, maybe it's a B2B marketplace, or if it takes 50%, the range wouldn't apply. But pre-seed round, you're basically at launch, you probably have no sales or negligible sales, and most people these days are raising. And by the way, the raise amount and the raise and the valuations are kind of the same across the different categories. It's just that the metrics used are a little bit different. But you're typically raising $750K to $1 million at like 3 to 5 pre-money valuation. Your seed round, you're doing 100 to 200K in GMV a month. Again, taking 15%, that gives you maybe 30K net revenues, or that 10 to 50K range. And you're raising 2 to 4, like 6 to 12 free. Pretty big range. By the way, these ranges the standard deviation is rather high, because if you're a second-time founder and you've done really well the first time, you may command much higher valuations the second time. So there are many exceptions. This is the mean. Actually, this is the median. There are exceptions, especially on the higher end side, for extraordinary founders or extraordinary ideas that have more growth than is expected here, that leads to higher valuations. Now, as I said, with the pre-seed round that you raised, the $1 million, you need to get about 150K a month in GMV in order to get your seed round. And there's also an expectation of how much time goes by between the pre-seed and the seed. And that might be 12 to 18 months. Now, from your seed round, you're at 150K a month in GMV. To your A, we expect you to go from 150 to about 650K a month with an 18-month lag. And it's kind of the right level of growth. It's that 200-300% a year, or like 10-15% month to month. That the numbers are there. But of course, at that point, we expect unit economics to start to be working, scale to be there. In your Series A, once you have these numbers, you're raising 5-10 million, let's say 7 million average, at a 15 to 30 million pre-money valuation, like 25 posts, 18 pre, whatever. And with that, we expect you to get to 2.5 million, let's say 2 to 4 million in GMV, and you're raising 15, 25, 40 to 80. I mean, pretty wide ranges. If you look at the industry as a whole, what are the different stages? Pretty similar, frankly. You start with the love money, which is the fool's friends family money. You raise 250K at 1 to 3 million pre-money. At launch, you're raising the same million at 3 to 5 with no traction. Then at seed, because I can't give you GMV numbers, because it may be very different if you're an e-commerce company that has different types of margin structure, or a B2B SaaS company where you have like 95% margin. Let's say your net revenues should be like 10 to 50K, but all the numbers are kind of the same. So depending on the category you're in, you have these different types of valuations expectations. Now, if you fall far out of that, like if you're Series A, you're raising 30 million at 100 million valuation, which by the way is possible, some venture capitalists like us who are more price sensitive are less likely to be interested because it falls out of the norm, and as such, it's less likely that we're going to be successful. Now, there's some VCs who don't care, and I'm going to talk about why and who those are shortly. So it gives you a sense of what the norm is, understanding, of course, that there are exceptions. Now, last but not least, the venture capitalists that you talk to, whether it's explicit or implicit, first of all, they have an area of focus. There are many that only do the US, so it could be geographic focus. It could be a stage focus, Series A, Series B, seed, pre-seed. It could be a category focus, B2B SaaS, marketplaces like us, direct-to-consumer internet, biotech, green tech, satellites, nanotech, whatever. And within these categories, they have theses. And of course, if your idea is in line with that thesis, is great. Now, in our case, and I'm not going to go, I'll probably do next week an episode on what our current investment thesis is, both in marketplaces and across the board. But we have 3 sub-theses in marketplaces, and we have some thoughts on what the future of food looks like, the future of work looks like, frankly, the future of real estate. And they're based on megatrends, right? You want your idea to be aligned with megatrends. Like, give you an example in the food space right now. Right now, food delivery as a whole, is a large and growing space. But most people are like, man, this is kind of done. You have Seamless Grubhub, you have Uber Eats, you have DoorDash. Why would that be that compelling? But if you think through where we're at, we're in a world where, with the emergence of dark kitchens, with excess capacity of restaurants that exist today, we're probably in a position in the not too distant future to have extraordinary quality organic food with delivered to you probably for free, because you're going to have amazing density because of scale, or through autonomy, be it drones or vehicles, where you're going to be in a position to order extraordinary food delivered to your door in 15 minutes for cheaper than you would be able to cook it yourself, not even including the opportunity cost of your time. And that means not just the typical fast food that you're finding in the delivery apps today, but you're going to have every quality, every diet possible, from keto to paleo to vegan, et cetera. And once that exists, I can imagine a world where 50% or more of all the food consumed is ordered online. And it doesn't mean restaurants go away. They play a role in socializing. It doesn't mean people will stop cooking. Many people love it. And it's an amazing, probably celebratory moment for families. But it probably does mean that food delivery goes from 5% of food orders, and that's $1 trillion market today, to 50% or more over the coming 5 years, 10 years, with lots of, by the way, ancillary consequences on how houses are designed. You can imagine that in major cities, for instance, perhaps if real estate is that expensive and people don't, you can get food amazingly quickly at a great price, people don't have kitchens anymore. Anyway, so try to have an idea that's in line with the direction of humanity. And there are these mega trends, right? If you were in 2008, 2009, 2010, the mega trend at that time was the increased penetration of cell phones, where all of a sudden you have a supercomputer in your pocket with a GPS. What can you do with that? And that's what led to things like Uber. And so as these trends exist, and there are trends happening right now in online education and healthcare, et cetera, you want to be aligned with that. Now, not all VCs use all four or weigh them the same way. There are many VCs, especially in Silicon Valley and in San Francisco, that are going to tell you the only thing that matters is the team. And the reason they say that is like, look, if you have an extraordinary team, they're going to figure it out. They're going to nail it. And ultimately, the only thing that matters is being in the very few startups that generate all the value. And that's where I need to take a little aside on how venture capital works and how venture capital exits work. So in most of the world, in most things, follow what I would call a normal or Gaussian distribution. So if you look at like exits in general in stock markets, or if you look at human height, life expectancy, performance on exams, kind of everything follows this normal distribution pattern where you have a median in the middle or an average, and people are within, for the most part, one standard deviation of that median. And that's true for many, many things in life. But actually, it is not true for what I would call the hit-driven businesses. In the hit-driven businesses, and that's like the music business, the movie business, the video game business, and also venture capital, a few extraordinary mega deals may account for most or a lot of the returns. So if I look at the last 20 years, per decade, about 2 deals represent 40% of all the venture capital outcomes. So in the 2000s, it was Google and Facebook. And in the 2010, it's a little bit more diverse, but like Airbnb and Uber are going to play that role. And so the key for venture capitalists, especially in San Francisco, has been being in those deals. And if you're in those deals, you probably do very well. But if you look at and as a result, they have a tendency to play, I guess what I would call not Monopoly, but Powerball. They're going to the lottery. They want to be in that deal. And so you need to build the relationships and the network to be able to be in these deals, because very few of these deals generate the 50x plus. So if you look at all the exits between 2004 and 2013, and that's people going out of business, being acquired, or IPOs, 65% of the investments venture capitalists lost money on. They only made 50x plus and 0.4%. And so being in these few deals mattered a lot. And so for many venture capitalists in San Francisco, it meant, because most of these companies have been coming out of San Francisco, and that may be changing, it meant being in these deals. But if you look as why I'm not sure that that's the best strategy, most VCs actually lose money. If you look at how much they're returning, kind of 60% of VCs have been losing money, and only less than like 10% basically have been, or 20% have been making 3x or more, and that's the top VCs. And what's interesting here is they're highly correlated. The VCs that were successful in the past have tendency to be successful in the future because of history, brand, deal flow, etc. Now, at FJ Labs, we care about much more than just, the team. Now, of course, a late stage VC would say the business matters the most, right? So if you're really, really late stage and General Atlantic is looking at putting $250 million into your business, or a private equity company is thinking of acquiring it, there, of course, the terms of the team matter, but like the actual business, and I don't mean unit economics, I mean actual P&L and projections matter a lot. Now, in the early stages where we play, not so much. But the reason at FJ Labs we care about the team, the business, the terms, and all three need to be there, otherwise we don't invest. So they have to be collectively true. And to a lesser extent, the thesis, it's still 70% of what we do is thesis driven, is because I made a personal life choice many, many years ago not to be in San Francisco. And so by virtue of not being in San Francisco, I expected that I was not going to be seeing the very best deals. I was not going to be seeing the Ubers and the Airbnbs early enough that they were going to be the fund returners. I chose because I guess the way I think of it, life is a video game, and the high score in that video game is not how much money you have. That's not that compelling. The high score in that video game is how much life satisfaction do you have? How much happiness do you have? Do you have meaning and purpose? And for me, the right place to be was New York. Intellectually, socially, artistically, it was much more dynamic and interesting, and it's a place where I felt at home. It was easier to be connected to Europe, where my family is, my parents, my brother, my extended family, frankly, and to the Caribbean, which is near and dear to my heart. And because I chose New York, I'm like, okay, most likely, I'm not going to be seeing these extraordinary super unicorns that return the funds. And therefore, I need a business model that works. Even I can't just be backing the team. Like backing people who don't have a business model, which increases probability of failure, is probably not a good idea. Overpaying or paying, not caring the valuation, doesn't work if you don't expect to be in these companies that gives you the 1000x or the 500x, of which there are very few. And so because I expected not to be in there, instead of playing Powerball, I decided I was playing Moneyball. I was going to make sure that the economics worked, that the valuation is reasonable, and as a result, at FJ Labs, we've made money on about 50% of the investments, and often we've invested at 5 million valuation, sold at 50, and we're very happy. Or we invested at 10, and we sold at even 30, and we make the business work, even though I didn't expect we would see the very best businesses. Now, what's actually interesting, in a way, is that is changing. There's a democratization of where the companies are being created. There's a democratization of where success is. Think of Shopify, right, which is a $100 billion company, the latest $100 billion company, and that's based in Toronto. And now that it's becoming easier to build startups, I expect that comparative disadvantage we've had in the past of being in New York is probably going to go away. So with that, gives you a sense of how venture capitalists evaluate startups. Again, there are these 4 criteria, which I covered, and I will be posting them both on my blog and on YouTube. I'll leave them here for now. And as I said, they're weighed differently by different people. Gives you a sense of what we're looking for. So now I'll switch to questions, and I'll take a second to go through the questions that you guys have posted. So apologize for people on the podcast in terms of pauses as I'm reading through questions and trying to find ones that are the most appropriate here. Okay, so Olivier is asking at the beginning, what we should use for customer lifetime value? The thing is, at the beginning of a company, going back to the economics, you don't really know what the customer lifetime value is, which is why when I'm talking to you at the seed stage, I am not expecting you to know what your LTV is. I just want it to work for the next 12 month or 18 month. At this point, I just want you to be able to recoup your customer acquisition costs in 6 months and have indications that you're going to do 2 or 3x your customer acquisition costs over the first 18 months. What it ends up being in the long run, who knows, right? If it's 20x, amazing. We'll all be, doing cartwheels through the office and popping champagne. If it's 5x, that's totally fine too. But you don't know, and it's okay not to know, but you just need the early numbers to be compelling enough to get there. Okay, next question. The question from, I guess, a LinkedIn user who's not logged in is, would I want to invest in an AI-focused consulting firm or maybe AI in general? Now, what's interesting is what we venture capitalists like to invest in, for the most part, is actually the application of technology, not underlying technology. Every startup I invest in these days has AI, uses machine learning. It's just I wouldn't invest in someone just building or selling AI solutions. That's not particularly compelling. But if you're using AI to do something really cool, that's great, right? So if you're using AI to, as I take a photo to sell an item, you tell me, instead of the old way, I go to eBay where I need to type a title, I need to type a description, I need to come up with a price. If you use the AI can tell you this is the item, this is the price, this is the description or a suggested price, this is the category, and you've simplified my life, that's amazing. Or if you can do, better pricing, better yield management. So the application of technology I invest in, underlying technology, not so much, especially since I suspect here it may very well get commoditized. Google, Facebook, Microsoft, Apple may very well give you access to their APIs in terms of AI. And as a result, selling the technology may not be that compelling. The same way, if you're building drones, I don't think that's interesting. This would be the hardware becomes commoditized. But if you're using drones to do something interesting, be it delivery or identifying leads for leaks by flying over buildings, okay, that's interesting. Application of technology, yes. Igor is asking, what type of due diligence should we expect and what do we focus on? So it depends on the venture capitalist and the stage, but in the earlier stages, the due diligence really is going to be looking at your business model, looking at the traction you've had to date, verifying the numbers you're telling us are real, verifying that because there's not that much there, right? Like at the end of the day, and frankly, even sometimes checking references of founders can be counterproductive because often the very best founders were not very good employees. So if anything, I've had negative signal where the best founders had horrible reviews from their prior employers. So it's reasonably light, I would say. It's just verifying that, the I's are dotted and the T's are crossed, that you're incorporated where you say you're incorporated, that the legal docs are in order, and then that the numbers you're suggesting to us are correct. Now, later stage, it'll be much more arduous, right? Like for General Atlantic to write the $250 million check, they're going to check a lot more. But early on, different. So Igor is also asking, when should people start raising and how long does it take? So that probably is what's surprising to most founders the first time. It takes a lot of time to raise money. I'd say on average, from the day you decide to start raising and the day you have the money in the bank, average maybe 4 or 5 months and often 6 months because venture capitalists actually use the time they take to do their due diligence to talk to you as a means of evaluating how you're executing with limited resources in that time period. And so you definitely do not want to wait until the last one to start raising. Make sure you still have 6-9 months of cash in the bank. They have a compelling story before you go out of market and raise, and then you should get ready. And also make sure you go and talk to venture capitalists more or less at the same time, and you run a very effective process because you don't want to be at a first conversation with someone and at a fifth conversation with someone else, because otherwise you're going to get term sheets at different times. And if you do that, you're not going to be maximizing valuation. Okay, let me look at other, Mike Wash, the first name of Structure VC was Moneyball.vc. It's a good idea. There's actually a recent article that came out yesterday doing like Monte Carlo simulations, and I think Dave McClure shared it because it's also his underlying thesis for 500 startups, that if you invest in like 500 startups or more, you're going to do better, and therefore it's not about just getting the one company, but like actually having a process that works across scale. Now, of course, there's something funny that comes from investing in as many companies as we do, which is if we're investors in 500 companies, the likelihood that one of them is the super unicorn is also greater. Jonathan is asking, what are our bets in Brazil? So Brazil is interesting because it's a country that has had so much potential and always manages to like grab defeat from the jaws of victory, right? Like in the early 2000s, there was this moment where the commodity super cycle was perfect for Brazil. Like China was importing oil and gas and like crops that they were coming with, and the terms of trade in Brazil were amazing, and they had it all, but they passed ineffective economic policies under Dilma Rousseff and made the country less appealing. And so there was this famous Economist cover where the rocket ship like that Brazil was and started being like derailed completely with massive corruption, etc. Today, Brazil is not doing really well. They've been very hit by COVID. They have not managed well, but for some reason, kind of like in the US, the public markets are really hot right now. And so actually 2 of our companies are going public as we speak in Brazil, which is interesting, even though sadly the Brazilian currency is devaluated. Now, we are still investing in Latin America and in Brazil, especially. It remains the largest country in Latin America. There's 200 million people. It is by far the largest e-commerce market there, and there's the most innovation. I'm trying to think through investments we made in Brazil recently. We invested in a B2B fair type equivalent in Brazil recently, but we're looking at the Brazilian market. We're not as gung-ho, I would say, as we were in the early 2010s, but it's still an attractive market, and we're still active there. If anything, though, we're becoming more interested in Mexico and Colombia than we've ever been before. In the past, prior to maybe Rappi breaking out, we didn't really invest there. The markets were too small. There were no exits, but that's actually changing and changing very rapidly. Samir is asking, would I recommend approaching VCs or investing in competitors or close competitors or competitors in other markets? So direct competitors, absolutely not. Most VCs will not invest in direct competitors because that creates conflicts of interest, and you'd rather avoid them, which is the same reason I think someone asked whether or not VCs will sign NDAs before reviewing a deck. We will never sign an NDA because we don't want to take the liability and the legal risk. There's something funny that happens in the venture capital world where a lot of ideas seem to come to many people at the same time. And so when someone pitches us one idea, very often we end up getting like 10 people pitching us the exact same or variations of that idea at the same time. Now, we will talk to all of them, but we'll only invest in one. We don't like funding competitors. The exception, Samir, though, is if they've backed someone doing the same thing in another market, and then in Europe, in Brazil, or whatever, and that company is not interested in going to your market, or it's not in their plan ever, ideally, definitely not in the next 5 years, then actually there's a clear value add in working with them because they can really be helpful and thoughtful. So these days, we've been investing in B2B grocery marketplaces. So the marketplaces to help grocery businesses or grocers get supply automatically, and we've done that in Germany. We've done that in Colombia and in Mexico. We looked at it in Pakistan. We looked at it in Egypt. We looked at it in Nigeria. We were looking at it in the U.S. And of course, these are not competitive. They will never be competitors, but there's so much learnings to be had by sharing best practices, frankly, even organizing a conference between the founders. So if they're invested in someone internationally, not an issue as long as they're not coming to your geography. But in general, when we introduce portfolio companies to venture capitalists, we first eliminate all the VCs that have invested in competitors because obviously that's a waste of time. Now, people have good ethics, so they would not be sharing your data and they would not be sharing your deck, but it's a waste of time. There's no reason to be talking to them to begin with. Okay, let's go to a few more questions. Do need to leave in 15 minutes as I will be answering a panel on angel investing, but happy to spend the next 15 minutes with you guys. Is this an investment a one-man decision? How does the IC need to have unity? So Omar is asking, I assume for FJ Labs, but I think it varies across different venture capital firms in terms of, do you need an investment committee to have unanimity, or can one person push for it? I think different people have different rules. I've seen many venture firms where you need unanimous decision making, but ex post, if you look at the companies that actually, the venture capital firms that do not require unanimous decision making, the most interesting companies were usually the ones that were controversial, where some people said, no, this is a terrible idea. It does not make sense. And so I recommend for most venture capital firms not to require unanimity. In the case of FJ Labs, we tried, if someone has real conviction, we'll back them. And even if my partner Jose and I disagree, if one of the principals or associates says, look, this is a deal we need to do, maybe we're not going to write a huge check, even if we disagree, we will make an investment. And but we will note, like, what were the dissenting opinions, not to go back and say, we were right, we were wrong, but more in terms of what was the thinking and what was the thinking correct or incorrect. In the case of FJ Labs, though, I'm probably the more aggressive or bullish, or I don't know, but bullish, optimistic. I'm the optimist of FJ Labs, where I want to believe that the entrepreneurs are going to succeed. I want to believe that they're going to be transforming humanity for the better. And as a result, I have a tendency to invest a lot and to be more aggressive and want to write bigger checks in more companies, which is why I think we're investing in like 140 companies every year. But that's perhaps more a reflection of my personality than a reflection of anything else. Pauline is asking whether or not VCs evaluate married co-founders. Are we at a disadvantage? It is. Now, the number one reason companies fail is usually, or one thing that will guarantee a company failing is co-founders fighting. And that risk is amplified if you're married to your co-founder. So you're definitely at a disadvantage when you're fundraising. But if you can prove that it works really well, it's also an advantage, right? Like that, it may be a weakness, but it's also a super strength because you understand each other perfectly. You can, in a way, finish each other's sentences. You're extraordinarily complementary. So we have backed married founders before, and so far, knock on wood, we've never had issues with them like breaking up, separating, etc. But it definitely gives one pause when we see that the founders are brother and sister or married or whatever, because it creates more risk of blowing up for internal reasons. See what other interesting questions we have. Would anyone want to invest in crypto that doesn't rely on the internet? Not sure what crypto that doesn't rely on the internet. I'm not sure I understand the question, but there's definitely a lot of interesting crypto investments happening right now. We're still in the early phases of crypto in the sense that we're not at the application layer yet. It's too hard for most people to transact in crypto, other than buying Bitcoin and Coinbase, and so we're still building the groundwork in terms of the protocols that are going to be used for crypto to be mass market. So right now we haven't invested in any actual marketplaces, for instance, in crypto. I don't think we've seen a use case that requires it. But is crypto as a category interesting? Absolutely, and happy to talk in a different section about why. I may actually do, seeing all the questions I see here, a Ask Me Anything session in a few episodes, and where I'll cover whatever people want to talk about. Okay, Andreas is asking, what do I think about Germany post-COVID? Germany is definitely the most interesting venture market, and I'll answer specifically for venture in this case. The venture market in Europe, Berlin as a thriving ecosystem. It's by far the largest market. You have the most unicorns coming out of it. You have an extraordinary level of creativity that's that's coming out of there. And so, if I have to choose which market to win in Europe, I would choose Germany above anyone else, except, of course, for most founders in the US, it's hard because of the language barrier, and so they pick the UK as the first market to go to. But I'm bullish on Germany. Frankly, I'm bullish these days with the no-code revolution and the open source revolution, where it's cheaper than it's ever been to build startups. I would absolutely recommend being able to, you can build a company from anywhere. And so we're seeing ecosystems come up in Paris with like Station F. We're seeing great companies being built in the Nordics, which have small markets where they go to the world. So I'm very optimistic about the future of creativity of humanity, where more companies are going to come out of unlikely places. And frankly, the profile of the founders is going to change, where you're going to have people creating amazing companies who weren't necessarily tech savvy, didn't go to Stanford, and it'll be great. So Matthias is asking, would I rather have an A team with a B project or a B team with an A project? Well, in the case of FJ Labs, both are required. In the case of FJ Labs, so most VCs will tell you they'll take the A team and they'll back them no matter what, and they'll expect the team to figure it out. In our case, because I think if you back an A team in a bad business or bad unit economics, if you can't get there, it does decrease the probability of success dramatically. And we are the Moneyball investors. We want most companies to do well. I want both the team to be great, the business to have good unit economics, to be an interesting business, and the deal terms to be fair. And I don't mean inexpensive, especially in this day and age. All startups are raising at high valuations, but I want it to be fair and attractive. In a post-COVID world, where funds pulling back or limiting focus to the core of their investment philosophy. So it's definitely been true that, especially in March, April, where people were really frightened, many venture capitalists said, okay, we're only going to help the portfolio companies make sure they survive. And narrow our focus to really our core focus, and probably that remains true. But what has changed for us is not are we only helping portfolio companies? If anything, we're investing more today than we ever have before. We're seeing more opportunity than ever before. The reason I think COVID is interesting is if you look back over the last 120 years, times of crises have been the times of the greatest creativity. So the Great Depression saw the greatest increase in US productivity growth ever because people had to make do with less. And we're seeing massive innovation right now because of COVID in online education, online healthcare, remote work, categories that really were in their infancy because of COVID. And so I expect there's going to be a lot of innovation coming. So crises, what they have a tendency to do is to accelerate underlying trends. And this is accelerated dramatically. So there's more opportunity, I would say, in tech today than there's ever been. And so we're investing as aggressively as ever before, with a caveat. And the caveat is if you are in the 10% of categories or industries that are dramatically negatively affected by COVID, we're giving you a wide berth and we're not even looking at the deals. So if you're in travel, if you're in tourism, if you're in offline events, whether it's a business conference or maybe, the StubHub type businesses of like selling tickets in venues, in the offline world specifically, we would not be looking at these because who knows when we're done with COVID. It may very well be another 18 months before we find vaccines that work or treatments that work, or it just disappears and blows over on its own. And if that's the case, these businesses are going to suffer, and because they only raise money for 18 months, it's too difficult. So we're definitely avoiding these completely, but in the rest, as long as the business you have makes sense, it made sense before COVID, and makes even more sense today, we're looking at it. And there's more innovation happening today that I've seen probably in the last 20 years. So I'm extremely optimistic and bullish in terms of the companies that are going to come out of this and the impact they're going to have on humanity. So David is asking, or is saying, and suggesting that customer acquisition costs went down during COVID, and that's absolutely true. A lot of people stopped spending money on marketing, and so two things happened. Fewer people, the way online marketing works today in Google and Facebook, it's auction driven. So if people are bidding on the keywords, the cost per click goes up. If you have fewer people bidding, the cost went down. At the same time, a lot of people were at home with nothing to do, and they were buying more, so the conversion rates were going up. So the combination of lower CPCs and higher click-through rates or higher conversion rates was extremely successful in lowering customer acquisition costs. This has already started to abate today, but clearly people were at home who have, frankly, in many cases, more disposable income. People are not spending money on international travel, on plane tickets, on hotels. They're not spending money on going to restaurants and going to musicals. And so the savings rate increased, and the purchasing power of many people has actually increased pretty dramatically. And we're seeing a lot of e-commerce companies do really well as a result. And not just the ones that are the most logical. Obviously, online food delivery companies, Instacart in the grocery space, these are doing extremely well. Or Drizzly in the alcohol delivery. But even normal e-commerce companies are benefiting from people's purchasing power being higher. Manish Rahman is asking me if I've invested in Pakistan. So first of all, I built one of the largest companies in Pakistan, OLX, which is the leading classified player of Pakistan. It's really integrated in the fabric of society there. It's what Craigslist would be if it was actually run logically, with moderating content, catering to women, not having murders and crime and spam and scam, etc. And so we've been very successful in Pakistan. In Pakistan, we've evaluated a lot of companies. I don't think we've pulled the trigger on one yet, but we're definitely getting close. We actually we told a few companies we're investing. We didn't make it in. We tried to invest in Retailo and B2B marketplace grocery space. Didn't happen. Not sure if it's the end of the world, because frankly, after we made an offer to invest in them, 5 others kind of showed up doing the exact same thing. And so maybe now we'll just wait until the next round. So definitely open to investing in Pakistan, though it has not happened yet. But definitely in the second tier countries. If I look at where we've mostly invested to date, it's been US, Western Europe, and India and Brazil. The next tier of countries we're looking at, Nigeria, Kenya, Mexico, Colombia, Pakistan, Indonesia. just starting to be more active there, and I expect amazing companies already come out of there, but more amazing companies are going to come out of that. How true is the quote for you from Matthias, or ideas are worth zero? It is very true. Ideas are frankly a dime a dozen. What's interesting is ideas have a tendency to be in the air. Very often, as I said, many people come up with the exact same idea more or less at the same time. That's why when people worry about like someone's going to steal my idea, frankly, doesn't matter. If you cannot execute on your idea, that idea is not worth anything. And so what matters as a founding team is that you know how to execute that idea. So if someone came to me and said, I have the best idea in the multiverse, and maybe it's actually true, but I don't know how to execute it, I'll give you the idea, but you execute it, because let's say I wanted to be CEO of that company. What percentage of the company would you give me for the idea? Max 5%. Frankly, maybe 1%, because really the genius is in the execution. You need a good idea, but it's not enough. Yeah, execution is key. I totally agree, Rui. And it's so hard. And people underestimate the execution. And frankly, the magic comes from executing, because as you're executing, you test a lot of things. You're testing different business models. You're testing, you're throwing so much spaghetti on the wall to see what works, what the site looks like, what every wording in the site, what partnerships work for, what distribution channels, everything needs to be tested, and you keep refining. So complexity in businesses, or bottoms up, it's never top down. You end up with a complex product because you tested so many things that it led you down avenues and paths you would never have imagined before. And something, frankly, that I recommend doing in people's personal lives as well, not just in people's professional lives, in terms of iteration and finding things that are different. I'm jumping into panel in 3 minutes, so I will be ending the stream here. This was fun. I'm glad to see so much activity. I guess making it work on LinkedIn was a success and a good idea. Put ideas. I'm gonna cut this, put it in my blog post, post it on YouTube. Put ideas for future shows in the comments. Obviously, like it if you like it, and look forward to seeing you next week. Next week, I'm thinking of talking and covering about the FJ Labs current thesis in terms of marketplaces, and also more general thesis in terms of future work, future food, future perhaps of real estate, etc. Anyway, it was great, and see you next week.